My stock is tanking, but I can't just bring myself to sell it. Because if I sell it, the loss becomes real.
What he is experiencing is loss aversion from the prospect theory, where people feel the pain of losing twice as strong as the pleasure of gaining. If you win $100, you'll feel pretty good, but if you lose $100, the pain will be twice as strong. Take Edward, for example. He bought shares for a tech startup at $50 each. At first, things looked promising. The stock climbed up to 65 and Edward felt confident. But then it started to fall. At 40, Edward told himself, it's just a dip. I'll wait it out. At 30, he said, it's too late to sell now. I'll hold until it recovers. But deep down, Edward was stuck in a psychological trap. Edward was experiencing loss aversion. Selling would mean locking in a loss, and that felt unbearable, so he held on, hoping for a rebound. But Edward's decision wasn't based on market fundamentals. It was based on emotion, and that emotion was costing him. The stubborn holding of losing stocks is called loser stocks. Edward's behavior wasn't just about stocks. It reflected a deeper pattern, one that shows up in everyday decisions. When Edward was ahead in the game, he played it safe. He avoided risky moves, trying to protect his lead.
Don't risk it. I've got a good lead.
But when he was behind, he took wild chances, buying expensive properties, making bold trades, anything to catch up.
I've got nothing to lose. Might as well go big.
This is called asymmetric risk attitude, a key idea from the prospect theory. We become risk-averse when we're winning and risk-seeking when we're losing. Edward's investing followed the same pattern. When his stocks were up, he sold early to lock in gains. But when they were down, he held on, or even bought more, hoping to recover. He wasn't making decisions based on analysis. He was reacting to how he felt. Fear when winning, desperation when losing. Another trap Edward fell into was anchoring, using the price he paid for a stock as a mental reference point. Even though the market had changed, Edward couldn't let go of that original number. It felt like a line between success and failure.
If I sell now, I'll lose money. But if I wait, maybe it will bounce back.
But the market doesn't care what Edward paid. The only thing that matters is what the stock is worth now and where it's likely to go. Eventually, Edward realized he wasn't investing. He was reacting. His decisions were driven by emotion, not strategy. We've seen how Edward's emotions led him to hold losing stocks, sell winners too early, and anchor to past prices. But there are ways to fight back, tools and habits that help us invest smarter. First, set stop-loss limits. These are automatic triggers that sell a stock when it falls below a certain price. It's a way to protect yourself from making emotional decisions instead of panicking or hesitating. Second, use data, not emotions. Don't rely on gut feeling or hope. Look at financial reports, market trends, and valuation metrics. First, diversify. Don't put all your money into one stock or sector. Spread it across industries, asset types, and regions. Diversification prevents you from volatility and reduces the impact of single bad decisions. Finally, reflect on your past decisions. Ask yourself, what went well? What didn't? What emotions were driving me? Edward didn't become a perfect investor overnight, but by using these tools, he stopped reacting and started planning, and that made the difference.